Hey everyone, thanks for joining. This is the Credit Pulse Podcast. Today we're breaking a common myth in credit, and that is that credit insurance is your safety net. I'm joined by my co host and our VP of Marketing and Customer Success, Melanie, as well as Mike McDermott. Mike is the president of Trade Confidence.
Yeah, thanks, Jordan. Really excited for this episode. We're going to unpack a lot about how modern credit processes like digital onboarding and monitoring can actually give companies more leverage and better outcomes with insurers. So, if you use credit insurance or are thinking about it, hopefully you can take a few things away from this call. But very excited to have Mike here.
Yeah, Mike, for folks that don't know you already, can you give a quick overview? And we'd love to hear about your background and how'd you end up in credit insurance in the first place?
Yeah, thanks for having me. Really excited to talk about this. But how I ended up in credit insurance in the first place. I'll start there. A headhunter called me and said, "Hey, would you want to be in insurance?" And I was convinced I wanted to be software, and I said, "Absolutely not," and almost hung up the phone on me. And he said, "No, wait, it's more of a consultative sale. It's kind of what you're looking for." And I took the interview and fell in love with it. And I've been in credit insurance for a little over 13 years now. So my background in the space, I started with Euler Hermes, who's now Allianz Trade in 2012. Became a broker 5 years ago, so I can represent all insurance companies to find the right solution for my clients. And with Trade Confidence, the vision behind starting that was to be a true consultant in accounts receivable, a broker not only for insurance but for all the different software services, financing offerings that touch accounts receivable.
Yeah, you offer a lot to companies from what we've seen and in the folks we've met with. It's interesting you almost fell into trade insurance. That's what we hear from other folks in credit. Essentially, like no one really set up
It's no one's childhood dream to be in trade credit insurance, unfortunately.
but now it's hopefully your dream. Yeah, it's good.
Yes.
Excellent. Well, yeah, we're excited to dig in, and you've got this amazing background. From your perspective, what do you think most companies get wrong about credit insurance?
I think there's just this myth that there's really one way to do it, where it's full outsourced credit management. It certainly can be. You can have customers that run every single credit application they have. Even the $5,000 credit limit request through the insurer, where they're logging onto the insurer's portal and using the insurer's database to determine is that company creditworthy or not, and they live by the insurer's decisions. And for a company with no credit manager, no credit infrastructure themselves, if they want to fully outsource it, they can. But that's only one way to do it. There's a lot of different ways to structure a policy for companies that have more robust departments and processes.
I see. Sounds like an expensive way to go to throw all your accounts at a trade insurer.
Yeah, I mean, you're paying for each request, but I mean, I think it's for a lot of companies, if you're I don't know, a $30 million company, you've got 300 customers, maybe at that level, like it doesn't make sense to hire a credit manager with benefits. Maybe there's not 40 hours of work to be had there, and you want to outsource it, and it's a fine solution in that space. It's just it's not the fit for all companies, particularly companies that do have credit infrastructure.
Yeah, yeah. It sounds like it makes sense for some of these smaller mid-market companies or top end of small business, and I've seen that. I think it was a logistics business. Like we've seen a bunch of those kind of say, "Hey, here's our whole book. We're gonna send these to a trade insurer because we don't want to manage it."
Yeah.
And then they start to grow out of that essentially and have to pick some accounts. But I guess when you look at all the companies you work with, like what's a better structure look like for those teams as they mature, or if you meet them when they're already mature, like what does that look like, and what's a good model?
Yeah, so again, there's two ways that insurers underwrite. It's the buyer underwriting that I just really described, where everything gets outsourced to the insurer. And then there's discretionary underwriting. And what that means is the insurer is really underwriting the client, the supplier, on how they manage credit. And they say, okay, tell me what your process is. How do you vet credit? How do you monitor credit? what technology are you using? Give me, an approval matrix of who has authority. What's the team look like? What kind of experience do you have with credit? And then let's endorse those credit policies and procedures to the policy. So you're really giving the underwriting pen to the client and saying, you set a threshold, which is called discretionary coverage for small companies that don't have too robust or developed of a credit department. Maybe it's $25,000. For larger businesses, maybe it's $250,000, where you say below that level, the insurer doesn't need to look over your shoulder and see what you're doing. They trust you that you're following a good process, and so long as that buyer passed your credit procedures, they're covered. You never have to go to the insurer and interact with them about that credit limit until there's a claim, and then they just want to see did you follow your processes. So it's having that in place, you have a lot less friction. You're not bickering back and forth about, hey, we really think this customer's creditworthy for $50,000 and you don't, and here's why we think it is, or hey, you just canceled coverage on this account that pays us like clockwork. Why is that? So just kind of giving the customer a lot more latitude to make their own decisions where they do have robust credit procedures and tools. I mean, to me, makes a lot more sense than having an insurance company that really doesn't know your business and isn't as qualified to make decisions on your behalf. Running your credit department.
I like that. So it's still in the power of a corporate to essentially make these decisions, but it sounds like there's an opportunity for alignment on saying, hey, you can make these decisions on when you send.
Yeah, and there's guardrails for sure. I mean, you can't just give somebody $200,000 in credit because you feel like it. They do need to pass your credit procedures, but we write these procedures in a way that does give the customer a lot of latitude. You're not making stupid credit decisions just because you have this insurance policy. We need to avoid that moral hazard, but it is giving the supplier, a lot of latitude.
That's smart. Yeah, giving choice there makes a lot of sense. I wanted to jump to a little bit on, if you look in the past and now, why does this matter more now than it has in the past? And I guess what I want to ask you is why is this a conversation we're having now compared to what this conversation might have looked like a few years ago?
I think because we're finally now in a technology revolution in credit, where you think of all the other facets of business, of sales and marketing and logistics, these were all automated, with CRMs, all these different tools, years ago. And now just coming on the scene are companies like Credit Pulse and whether it's digitizing credit apps, whether it's payment portals. There's a lot of great collection software out there where you can see how companies days beyond terms are changing. There's a lot of different technology, so much more so than when I started back in 2012, that companies are just now starting to take advantage of and weave into their procedures. And what's interesting to me is that it's the underwriters in credit insurance, a lot of them don't even know about this yet. So it's really incumbent upon me to educate them on saying, hey, look, here's what the supplier is doing to manage credit. And if you get the right underwriter's ear on that, and they go, wow, that's phenomenal, and we can offer some better terms because of it. And I think it's something that a lot of companies don't realize, that the insurers care so much about how you do things because they're the ones taking the risk, but they're so far removed from the day-to-day operations that the supplier is really the first line of defense. That's the insurance company's money that's out there. It's their risk. So they want to know, hey, what are you doing to properly manage credit and collections? And with all the technology that's out there today, back to your initial question, I think there's so much more that can be said about practices. I mean, it's one thing to just say, hey, we get 3 references and a bank reference. We check a credit bureau. We can all say that, but if you're actually investing in technology and can show how you're doing things like preventing fraud, for example. I think that's something that when I'm making the internal sale to the underwriters that really holds some weight.
Yeah, that makes sense. It's almost a double-edged sword. Like when I started to think about this industry, salespeople get all the budget, it seems like, and there's this, there's always been this huge focus on the top line, and for whatever reason, not enough on the bottom line, which is really where I see trade credit and also trade insurance having a huge effect. So, we're, Mel and I are in the business, but we've never been more excited about bring this technology to the market, and maybe it'll help people even save on their trade insurance, as well as kind of the underwriters dig in and understand how this affects things like collections and DSO as part of that. I guess I wanted to ask you, like, as you think about this technology, and if you forecast out a little bit, like, how do you think this changes the insurance conversation either now or in the future? What do you think that looks like?
I think in the past, all we really had in automation was trade credit insurance portals, where it was this, hey, this is amazing. You can just log on to this portal and say, ABC Company in Philadelphia, Pennsylvania, I want to give them a $50,000 credit limit. Click, and it's approved. Amazing. They looked at all their information and they approved that limit. The problem is there's only 3, maybe 4 insurers that have that type of portal, yet there's like 15 plus in the space. And I think what's exciting about what you're doing and this whole idea of digital credit applications is that it in a sense replicates that insurance portal, where if there's a customer that's using Credit Pulse and they say, this is how we're gathering our credit bureau information, our trade references, our bank references, which is phenomenal for cash flow accounting for small accounts. I don't think any of the credit insurers really mirror what you're doing there. It just opens the door to now I have so many different insurers that I can go to, right? Where I have, I can approach any of the insurers, I can approach all 15, and that it just opens the door for, better value, where the way different policies, language works, or what sectors one underwriter might like versus another, what individual buyers. Maybe they have one key buyer that most of the insurers are not willing to cover, but there is one that will. When I can, kind of spread, that application out to multiple insurers, it just helps me to not, get pigeonholed into, just 3 options. More options is always better. Interesting.
I know there's kind of a big 3 or 4 insurers that you work with, and then there's this whole host of some of these smaller insurers. What's some of the benefit of you and your customers working with some of these maybe lesser known insurers?
Yeah, well, I mean, I wouldn't say lesser known. Sure. I'd say they don't have the labor force is really what it boils down to. Of like the big 3 customers, they have a team of, you each have a team of like 500 underwriters, maybe more across the world, and they're set up to field 6,000 credit limit requests from a customer. They have the ability to do that. The customers who have a smaller footprint in trade credit are still household insurance names. Companies like Nationwide and Liberty Mutual have credit insurance arms. They just don't have an army of underwriters to make decisions. They have underwriters that will underwrite the policyholder and how you make decisions, and then say, okay, just follow your procedures. So I think with those insurers, where you have a robust credit department, it's a much cleaner relationship, a lot less back and forth and administrative lift, and they're also offering non-cancelable coverage, which with coverage is traditionally written on a cancelable basis, which means the underwriter is part of your credit team. Because you don't have a credit team, Mr. Customer. We're going to look over your shoulder and we're going to help you make decisions. And if we see something going sideways with one of your customers, we're going to reach out to you. We're going to say, hey, stop selling this customer. We just received a claim from another policyholder, or they just got downgraded to S&P, triple C negative with negative outlook. And you're probably not watching that, and we are, and that's great for companies that aren't watching it. For credit teams that are watching and they don't need that oversight, the insurer says, okay, here, look, we're going to give you $1 million on ABC company, and that's good until the end of the policy period. We can't touch it. You continue to manage your credit policies and procedures, and if those procedures say, hey, if a company gets downgraded to S&P CCC negative, that we need to put them on credit hold, then fine, do it. But otherwise, you're just following your own procedures. So it's just a lot of times that guarantee of non-cancelable coverage is very important to customers, particularly if they have a concentration. If they say, look, if the insurer cancels coverage on Walmart, well, 40% of my sales are to Walmart. Operationally, I can't just stop selling them.
Yeah.
So I need that coverage for the duration of the policy.
That sounds very valuable to have the non-cancelable term as part of that. When Mel and I were prepping to meet with you and to interview you, one of the things we were wondering about is how underwriters really think about risk, specifically this trade risk and risk of receivables. Mel, I think you had a few questions for Mike.
Yeah. Yeah, I mean, being on the customer success end and also through the sales process, we often hear from people, that's just the way we've always done it. And so it's so fun to be in the space where we can see what the outcomes look like with these new ways of approaching credit and also seeing it become the new standard and then realizing what can come from that. So I think as we think about ways to kind of inspire people to understand this and inform their credit operations in ways that could help them in better ways, and use credit as the first line of defense, would love to hear from you. You gave a few examples before, but what are underwriters really looking for when they're evaluating risk?
So on the buyer side, when they're underwriting, if I'm, can I approve $1 million credit limit on an ABC company? They're looking for all the typical credit metrics you'd think of average days to pay. They're looking at liquidity, profitability, years in business, sector, geography. Are there any major fluctuations in days beyond terms? So I don't think there's any crazy secrets in how they underwrite buyers. Probably how most credit managers are doing things internally. On the discretionary underwriting side, they're really just evaluating that team of what's my first line of defense. If I'm going to write this policy where I'm going to be paying for the risk of non-payment, I want to know who's steering the ship. So it's what's the team look like? How many years do they have of managing credit? What tools are they using to manage credit? What's their processes? Are they loosey-goosey of we get references and we look at them, we make a decision? Or are they regimented? Is there, maybe there's some math behind them that says we get 2 references and, so long as there's not any adverse information, we can give up to 150% of the previous high credit limit that any other supplier has given. The more detailed, the better. But, I'm sure you've seen credit policies and procedures, some of which are half a page, some of which are, a binder. And the underwriters like the binder.
Mm-hmm. Absolutely. And have you seen some of those scenarios where that's played out, where the decision or the outcome was influenced by the maturity of some of those processes, especially on the discretionary side?
Yeah, I can give you an example of a client of mine. It was in the metal sector. It still is in the metal sector. I don't know why I said was. But they had more of the buyer underwriting approach, where they were, what I explained earlier, of the 6,000 customers, insure, underwrite all of these. And they were having problems with it, where their credit manager was disagreeing at times, and it became a lot of administrative lift. And we said, let's have a robust, credit checking software application that you're using, and let's let's build these procedures together. I helped them write their procedures, and they do have a very experienced credit team, so it was a collaborative effort. But in putting together these procedures that I knew the insurers would like, we were able to basically reduce their spend by I think like 20-25%. Beyond that, their discretionary coverage, which is where they get to make their own decisions, it was at 25,000 with a $75,000 cap, which means you can give approval for up to $25,000 per customer, but we, the insurer, we're only going to pay over the course of a year $75,000 in claims to, based on buyers that you approve yourself. So if you have a claim for $1 million limit that we underwrote as the insurer, that's not impacting it, but it just where we, the insurer, have no visibility to what the client's doing, the most we're going to pay out on claims is $75,000. So that was at $25,000 per customer, $75,000 aggregate. Just by saying, hey, this is how we manage credit, we were able to raise that to $125,000 single limit, $500,000 aggregate. So it just, and they have just the nature of their business. It's all small accounts. That would be 90% of their customers have credit limit needs below 125,000. So it just, there's so much less day-to-day friction, administrative lift, because the customer can make their own decisions.
Yeah. And I've had the privilege of seeing you, your process as you work with customers and really think about this from a more broader perspective. And it really, always impressed by how collaborative you are in thinking about things that people aren't thinking about themselves, and what are the tools they can bring in to make sure that they're getting these opportunities, benefits, and really leverage of how their process can look.
Thanks.
Yeah.
I like to say it's from credit application to cash application. Like there's so many little things throughout that entire AR journey that if you take a step back that can potentially be improved. And I just kind of feel it's my job to put together that whole cohesive solution.
Absolutely. Well, I'd love to dive in a little into what this modern approach looks like. Jordan, I think you have a couple questions on that.
Oh yeah, sure. I guess like we're kind of right in the middle of developing lots of new technology for this world, and I guess if as you see it changing, where do you see the biggest impact on trade insurance or B2B trade overall? We'd love to know kind of what's moving the needle from your perspective.
Yeah, I mean, I think a big thing is what you guys are doing. I think giving customers, with all of the, I think the fraud checks that softwares like yours provide, the cash flow underwriting, I think, is something that was severely missing from traditional credit insurer portals, to be able for these small businesses where, if it's Mike's Pizza Shop, my credit bureau report probably doesn't look like anything. Like there's not going to be much there. But if you can see, what my bank references look like, and am I cash flowing every month? That's often a better indicator of the credit than a credit report where 5% of my vendors report trade data. So I think in credit, information's king, right? We're trying to use our crystal ball and decide who's going to pay and who's not. And I think having a better crystal ball that all this great software that's coming on the scene is providing, I think that is what's really changing the game in credit.
That makes sense. Yeah, we've certainly seen initially there was a lot of friction on getting data in the first place, and you need that data to make a good decision. So easier you can get it, better decision you can make, and it makes sense that it flows all the way through to your cash application. I guess I want to talk to you a little bit more about buyer underwriting, how it might work within a corporate versus when it's working at a trade insurer. One of the things that has surprised us is usually when we start working with a customer, a high percentage of them do not have a formalized policy on how they go about this. And we're like, wow, some of these are sizable companies with large teams. And we're like, how do you ensure consistency? And they're like, well, we hire the right people and we talk about it. And I'm like, well, what happens when things go wrong? So I'd love to know. I know you've helped quite a few folks sit down and write either their first policy or improve the policy that they already have. How's that happen? Like, how do you think about that? And would love to dive in there a little bit if you have any best practices you're willing to share.
Yeah, I mean, I think the most common answer you get to that question of, hey, do you have formal credit and collections procedures is, well, like we kind of do, we're working on them, or we don't, we know we should. And like it just leads itself very well into, well, can I help you put those together? I have templates, like let's sit down and, and talk through it together. And in, a half hour with, your team, we can, put something together, that you can put into practice. I mean, I think it's something that any company that's serious about credit needs to have, not only just for their internal practices, but if they're interested in credit insurance. I can't tell you how far that goes. When I'm talking to these underwriters and we're trying to price a policy. It might make a 20 to 30% swing on premiums and deductibles. Because if you think about it, let's put yourself in the underwriter's shoes where, you want to try to be aggressive and win this policy. And you've got, your algorithm on what this thing should cost. And if you want to go outside of that, you need to document why. Yep. What better thing to have than credit procedures that say, I'm putting my name on this policy that is severely underpriced because this is how this company manages credit and I want this deal. So it's really kind of the art of how, think things, of what I do, is that internal sale to the underwriters that just having those procedures makes all the difference.
Wow, that's hugely valuable. The service you're providing and helping people get. It sounds like almost a litmus test of like underwriters asking, is their house in order? If it's not in order, you're priced on a regular policy. If it is in order, we'll take a deeper dive and probably can drive that significant discount. So that's huge. I do want to ask, we Mel and I know the kind of the larger insurers, but I know one of the values you provide is you work with all of them and find the best connection for your customer and the best policy. But specifically, like for these smaller insurers, like how do they approach trade insurance differently than the larger ones?
So the smaller ones, meaning the companies that have maybe a smaller footprint in insurance, but they're still, I mean, we're talking, multi-billion-dollar, insurance behemoths that are household names.
Yep.
How they approach it is that first of all, they're not dealing with SMBs like the kind of the big three insurers are. Their entry level is probably $25,000 in premium. And their target market's going to be $50 million plus in revenue. Really focusing $100 million plus. And like I said before, they don't have the infrastructure, they don't have the database, they don't have the army of underwriters to make every single buyer decision. Their approach is so much less on buyer underwriting and so much more on policyholder underwriting, of underwriting the credit department, underwriting the procedures, and saying, I like how this company manages credit. I like the sector that they're in. That's a sector that we want to grow in, or geography that they're in. If it kind of fits, it fits into their paradigm of what type of business they're trying to grow with. And that's kind of my job of knowing which insurers like retail and which like solar, whatever other industries. They all have their industries and geographies that they want to grow in and different things that they look for. So it's just navigating that and finding which insurers to approach for which opportunities.
I see. That makes sense. I guess if you have some advice for credit managers out there, where do you think they should focus their time? Whether it's 2026, this new year upon us, or going forward, where do you think their time is best spent in your perspective?
I would say not getting lost in the minutia. You don't like I hear people talk about credit references, and I mean this still, as you know, still happens today. Of you get 3 credit references, and people are picking up the phone and calling these people and emailing them and following up with them. That's a colossal waste of time, in my opinion. That needs to be automated or not done at all. There's so much that technology can help you with, where, I mean, we can have an AI bot, field all the information that, you're collecting through a Credit Pulse app and give the credit manager, kind of be their little assistant and say, hey, I took a look at everything based on all the, the credit procedures that you fed me. And based on that, I think that this customer's creditworthy for a $50,000 limit. And just to be able to look at that and, rather than doing all that digging themselves, kind of outsourcing that to technology, I think is great. And another thing I would say is there's always the friction between credit and sales. I think we should give this customer a higher limit, and credit says there's nothing to suggest they're worthy of the higher credit limit. I think with a lot of the credit monitoring tools that are out there now, where you can kind of flip the script and the credit team can go, hey, look, Mr. Salesperson, that other customer you're telling me we need to give a higher limit to is bad, but this one is clearly growing. Why don't you get off your butt and go see if you can drum up some more business with our customers that pay us well and that are growing and that we want to grow with.
Love it. Spicy. That's great. We've seen there's in our experience, often credit doesn't have a leg to stand on going into those discussions, but if they have the data at their fingertips and it's trustworthy, that's a lot easier discussion to go have. And then there's the the upsell, cross-sell opportunity, the greenfield case. So those are great points. I want to transition into our new lightning round. These are some quick questions. You got to answer them as fast as you can.
All right.
But this is how we're going to wrap up our time today. The first one I've got for you is, what's the biggest bet you see in credit in 2026?
The biggest bet, maybe a cop out, but I'll say just AI. I think it's we are in. There's so much data, right? There's all these different data points that credit is so rich with data that I think we're just really learning how to harness AI to make better decisions. And I think the companies that do that right are going to have the best crystal ball.
Got it. What would your job be if this one didn't exist? It's kind of funny to ask you that because you create your own job, it sounds like. What would it be if you didn't have this job?
I would be a stay-at-home dad.
Love it. One of the best jobs in the world.
Yeah. If only money weren't an object, I'd be doing that anyway.
Same.
Yeah.
Same. I think I'd be a really good mountain biker and stay-at-home dad. Would be, what I think. What's a book, when you think about all the books you've read, that's had the biggest impact on your work or maybe even your personal life?
I'll say 4-Hour Workweek by Timothy Ferriss. Just trying to find ways to be more efficient, more organized with how you go about your business.
Have you achieved the 4-Hour Workweek?
I have not. I don't think I've achieved the 40-hour workweek, so I might need to reread it.
It's a vision, right? That's what we're all striving for. But yeah, Mr. Ferriss has some good hits. That's a great book.
Yeah.
If you had one piece of advice to give your younger self, younger Mike, what would it be?
Take more risk. Believe in betting on yourself, and let the chips fall where they may.
I'm inspired.
Yeah. Jordan, I'm sure that's one of yours too, and why you started this company to begin with.
Every day, that's what I think about when I wake up. Yeah. All right, now we got a funny one. What's a holiday food that should just never exist?
Cranberry sauce.
You don't like cranberry sauce?
It does not belong on the Thanksgiving Day plate. It is a disgusting tart flavor that makes no sense next to turkey and stuffing and mashed potatoes.
We torture
I
ourselves.
have opposite views on cranberry sauce, though I get it, but I did tell Jordan ahead of this that mine is fruitcake, and we went to battle on that one.
I grew up in a family with a really good fruitcake. Ironically, I don't think many people can say that.
You're the only one.
Yeah, I think it was just soaked in booze. That's what.
There you
Oh
go.
my gosh.
Um,
Wouldn't that make it better?
oh, it makes great. Yeah, you don't even have to taste it.
Don't even taste the fruitcake.
The mine's turducken. I know it's a bit of a throwback, but there's no way you can cook meat and eat. Like, there's no way it's going to be cooked on the inside and not dry as a bone on the outside. And just like, why? Why is this a thing?
It's a thing so that John Madden can have 6 legs to give out on Thanksgiving football.
Amazing. Well, Mike, this has been really inspiring, very informative. Like, I've learned so much about trade insurance, and we really appreciate you coming on our podcast, and we hope to have you on again soon. Thank you.
Of course. Thanks for having me. This was a blast.
Thanks so much.
Thank you, Mike.
All right. Take care.